welcome to another episode of Talking Wealth. Today, I am joined by Ian Wenik. We're going to go deep on the RIA industry, the two biggest stress fractures. I'm talking about the organic growth slowdown and the unraveling of some of private equity's largest wealth rollups, from referral fatigue to valuation pressure to PE firms discovering the limits of financial engineering. We're going to take a candid look at why multi-billion-dollar platforms suddenly can't find an exit and what comes next for the firms caught in the middle. But first, a word from our sponsor. Today's show is brought to you by RBC Clearing and Custody. As a successful financial professional, you may be seeking independence and autonomy by starting your own registered investment advisor business. And if you've already transitioned operations to an RIA service model, you may be looking for a boutique custodian for clients who have sophisticated wealth management goals. Either way, RBC Clearing and Custody offers the resources, expertise, and solutions to help you accomplish your unique business objectives. With the support of an RIA custodian offering the full scope of the products, services, and technologies you want, you can focus on your most important asset, your clients. Visit www.rbcclearingandcustody.com today. All right, Ian Wenik. What's up, man? How are you?
That was such an ominous intro. It sounds like I'm the bearer of every piece of bad news on the face of the earth. Next thing you know, we're going to be talking about a literal stress fracture somebody's got.
You know, coming out of my mouth, it sounded bad. And with all the Giants injuries this season and the PTSD that we have, it felt worse. So before we get started on what we're going to talk about today, there was a profile over the weekend of Matt Bellany. For those of you who don't know who Matt Bellany is, he is a Hollywood insider. He is the host of The Town, a podcast on the Ringer Network, and he plays a very similar role in Hollywood as Ian does in our industry. And Ian, you yourself have a podcast that I also listen to. I don't think you're going to get a New York Times profile anytime soon, but I'm a fan.
I hope I'm not getting a New York Times profile sometime soon. Usually if another journalist is profiled in the New York Times, they've done something really, really, really bad. So let's hope for none of those anytime soon.
Okay, so here's what we're going to talk about today. This is a fact. Most RIAs do not grow organically in any meaningful way. The growth is coming from two places, maybe more, but two places, three places. The stock market, obviously. It's coming from acquisitions, M&A, and it is coming from the referral networks from the custodians. There was a stat, remember Mark Hurley's seminal to me anyway, Welcome to the Jungle? He wrote that a few years ago.
Yes, that was a very good paper.
So one stat stuck with me. They estimate, I think it was from a custodian actually, 70% of firms are actually shrinking. So the big news over the last couple of weeks in terms of throwing a grenade in the area of challenged organic growth is Schwab's referral network. The minimum referral that they used to give was $500,000. Now they're raising it to $2 million. They are very much on our lawn, ripping at our flowers. What do we make of this?
I mean, it's interesting. I mean, there's always been this tension between Schwab and the independent wealth management business because you have to deal with the fact that simultaneously it's the biggest individual service provider to RIAs, largest custodian, but also it's a direct competitor. I mean, we talk about football a little bit. You can watch any NFL game and you'll see those Carl Broker ads during a commercial, clearly trying to pitch a regular mass affluent client on dumping their wealth manager and working with Schwab's in-house FCs. So that tension has always been there. I think, I'll make an analogy. I think I've mentioned this before because I play poker. That's another hobby of mine. A lot of times casinos keep the poker room not because it's an actual moneymaker, it's a low margin business, but as an amenity to people staying at the hotel. But a lot of times you see this in Las Vegas, all these casinos realize we can make so much more money on that floor space by ripping out the poker room and putting in a bunch of slots with a guaranteed 25 to 30% margin. So if you're Schwab, it makes sense, right? Like you've given these RAs, they've grown to billions of assets and billions of enterprise valuation kind of on the backs of your generosity sending these clients to them. If you're Schwab, it's perfectly rational to do this. But if you're an advisor, I think it's kind of a reminder that, growth isn't easy. it takes time to develop the relationships that make growth sustainable. It takes on-the-ground prospecting seminars, podcasts like this. We will get into Edwin Financial Engines. The podcast drove a lot of growth there. So I think it's just kind of a reminder that if your business model is dependent on the generosity of an organization larger than yours, you don't really have much of a business model.
Before we get to Schwab's decision and the ramifications of that, the way it works, as far as I understand it, so Riddle's Wealth Management never participated in any of these referral networks. Schwab would give you a customer that had at least $500,000, whose maybe needs were too complex operationally, technologically, too sophisticated, whatever the case may be. They would give it to a partner RIA, of which there are currently estimated around 170 or so. And they would do a fee sharing arrangement. And I think they would take something like 25 basis points. I actually think they might have raised that because if this is the teat that you are sucking, forgive me for the crude analogy, you have no recourse. What are you going to do? They can do whatever they want. Did I describe how it worked?
Yes. And so actually we broke earlier in the year that Schwab was raising those fees by about 5% across the board. And that fee drops off after certain asset threshold breakpoints. But still, the bottom line remains that, you're giving Schwab a perpetual trail commission on assets that never moved in the first place. Like, that's just the reality. And a strong RIA probably runs at like low 30s, maybe the best of the best run in like the low 40s margins.
That's very healthy.
That's right. Like from the decks that I've seen some of these sponsors get from low 30s to very rarely low 40s. Even in a low 40, even in those kinds of margin environments, giving a 26 basis points to Schwab in perpetuity basically takes out half the margin you make off that client. So it's not only is it a difficult way to gain business, it's an expensive way to gain business too. And it also takes a lot of time and sweat equity building those relationships with the financial consultants at the Schwab branch offices you see in the cities and suburbs to get those FCs to refer clients to you, as opposed to a creative planning or a Mercer or a hyper regional firm.
When I saw this announcement, I guess my first thought was, oof, the firms that relied on this growth engine are in serious trouble. My second thought was, what took so long? I'm sure Schwab has considered this for a long time. They didn't just wake up one morning and say, oh, I have a good idea to add shareholder value. Let's do this. I'm sure there is a very good reason why it took so long. I don't know what it is. What do you think?
I mean, I think that it kind of tracks with, again, I don't want to get too speculative here because we haven't really reported significantly on it, but it's not a coincidence that Schwab has different leadership now than it did versus a year ago versus 2 years ago. So there's no Bernie Clark or Walt Bettinger there anymore. Obviously, John Beatty's been at Schwab a long time. He's a veteran there. He knows kind of how this stuff operates, but it's a different leadership structure. And maybe Rick Wurster has a different approach to working with the advisor services division than Walt did. I mean, that's the biggest kind of through line I can change because, you can't really index this stuff to inflation because these numbers, like the fees and the breakpoints, those stayed flat for basically 15 to 20 years. And Schwab had every right to point to that as a reason to raise those fees. I think it's just the fact that nothing happened for so long and then you have these two changes happen in the span of a year. It provides some sticker shock, I think, to advisors who might have gotten complacent.
Is there any doubt in your mind that this is not, maybe I phrased this question wrong. I have no doubt that this is not the last change that we're going to see. I would be very surprised if this is the last we hear from it, that $2 million is the final. I don't know when it goes to 3 or when it goes to 5, but it's going higher.
Yeah, I mean, I'm not shocked by that. And the other thing you have to realize is that you'll probably see similar things happen with Fidelity, which obviously has a pretty competitive and actually tighter membership network in its own referral network, Fidelity Wealth Advisor Solutions, or as we like to affectionately refer to it, WAS. It's also worth noting that there are kind of competitors trying to get into this space. So, we broke earlier this year and in 24 that Goldman in their RA Custodian was going to build out a referral program, and that Pershing third largest custodian by assets, was thinking about developing a referral program as well. Now, the difference between a Goldman and a Pershing is that they don't have a traditional client-facing retail channel the way that Schwab does, the way that Fidelity does, the way that TD used to before the TD Schwab merger. So those might exist, but it's not the same kind of mass affluent client base that most RIAs work with.
It's not easy to build out a network of expert financial consultants, financial advisors internally, whatever you want to call them. But let's be honest, it's not impossible either. I'm not saying that Goldman or Pershing could do this overnight, but if they look sideways and at what Schwab is doing and what Fidelity is likely to do, that's speculation, of course, and they want to get in that business, they have a big Rolodex of people that they can call to lead these efforts.
Yeah, 100%. 100%. I think you make a good point about the sheer amount of talent that's out there on the market right now too.
There's a lot. So how does all of this fit into the bigger story of the RIA landscape, which has had a massive tailwind of both stock market appreciation, expanding multiples, but at some point, and you reported on this, there are some firms that are so big that organic growth in the high single digits, in the teens, off a base that big, it's just not going to happen. And if you're not growing, and if the tailwinds contract or reverse, how do the investors get out?
I mean, look, that's kind of the existential question that we're all kind of, I refer to we as like the royal we, not me personally, that the industry is facing right now, is that there's been this kind of collective whistling past the graveyard because we've had all this incredible multiple expansion, kind of eye-watering headline enterprise valuations, but there's still some brute facts out there that I think make this kind of a difficult environment to get that kind of ultimate exit point. The first is that there's no real good public comp that you can use. I mean, again, like I'll get into my own hobbies. I collect baseball cards, I'll try to sell some for profit. It's very difficult to make money on cards sometimes when you have a lower comparable sale. Similar to the market environment for the RAs, I mean, Focus went private at about a 13.4x valuation. That was kind of in line with asset manager valuations, asset manager multiples. You look at the integration that they've had now, if Focus chose to spin out Focus Partners Wealth to another private investor, they could probably get an earnings multiple north of 20x for that business. It was an incredibly undervalued business because I think the public markets don't recognize that, yes, asset managers and RAs both generate tons of cash flows, but while asset managers' cash flows are depreciating due to secular headwinds, RIA cash flows are stable and sticky and transfer from generation to generation. But we don't have a public comp that's trading at the 20x, 20 plus x that the creative plannings and the Lido advisors of the world have gotten through their private trades. So what we're going to have right now is if anything goes public, we're going to have multiple compression and investors losing a lot of money. So if the IPO market isn't an option, especially for these sponsor-backed firms, your best choices are to sell to a strategic or to sell to a sovereign wealth fund. And we'll get into those a little bit, but those all have their pluses and minuses. And the issue with the strategics is that, as we saw with the Edelman process, there are very few strategics that are willing and able to cut the kind of check that would be able to absorb one of those wealth businesses. And at the same time, there are even fewer of those businesses that can cut that kind of check that provide the working environment that an advisor would want to stay in. I mean, look at creative planning and Goldman Sachs PFM. So many advisors left what was then United Capital through the sale to Creative because they were tired of being sold twice.
Yes, I want to talk about this idea. I'm calling the fray in honor of the band that we had at Future Proof. The next 10 years, you're going to see a lot of advisors, and I'm first starting to see it, that are, call it 40 years old, who have been through an acquisition, maybe two, did not have equity, and are looking around saying, hey, wait a minute. Where's the duration of my career going to be? I've built up a healthy book, $100 million or more, whatever it is, and I'm looking around, And now I know what strings are attached to the generous signing bonuses that we see. And maybe I don't want those strings, and maybe I want to go to an independent company. And obviously, this is a plug for Ritholtz Wealth Management. Let's be very clear here. But a company that doesn't have these external forces. And so the fray that I'm describing, for let's call it 2017, 2018 through like 2023, 24, we were getting way less knocks on our door from advisors than we had previously. And it was not a mystery. I wasn't like, where are they? I can't figure it out. No, it was very clear. If you have a book, you are getting a cold call probably multiple times a week. So, but now that story is playing out. The fray is happening where people that are inside these behemoths are saying, I'm not really interested in this being the thing for me. I want to go somewhere that I could serve my clients, not have anybody look at my calendar, not be beholden to anybody except for my clients. Do you see it that way too?
Absolutely. I mean, I think that, the RIA space is kind of what it is because it's led by people who are inherently entrepreneurial. And I think as you see these firms get bigger and bigger and approach hundreds of billions, if not trillions in assets under management. I mean, obviously there's some firms at $1 trillion already with 401k assets. They start to look like the wires that these people broke away from. And I think a lot of people went to the RIA space. I mean, one, obviously you get to keep a better percentage of the money you generate for a client for yourself. It's better for you kind of financially, but also you want the experience of working for a small organization, kind of running your own business. And if you're a W-2 employee at a company that's backed by 4 or 5 private equity sponsors or an insurance brokerage or a massive asset manager or a bank, you're not getting the same working experience that you wanted. And so it's created this environment where, see a lot of these people, again, we saw this with Golden PFM to Creative. A lot of people broke out and used firms like Mosaic or a Dynasty to go back solo again.
Yeah. One potential escape route, and this is going to be captured by, I don't even know if there's one or two companies that can do this. Obviously, Creative is in the lead here. But investors in public markets do place a premium on scale and consistency and reliability. There is a debate amongst public market investors. Make it make sense. Why is Costco trading at 45 times earnings? The business model didn't change. What changed was investor preference for you really know exactly what you're going to get. So if Creative can get out of the gate, they're in the lead, so I'm just using them as an example. But if a company can get out of the gate with $1 trillion under management, absent, of course, the market has a monster impact at that point. But maybe that's how they, whether it's Creative or anybody else, maybe that's one avenue to expand your multiple. But again, the difficulty of getting to that sort of scale cannot be overstated.
Oh, yeah, absolutely. I mean, look, Creative, if we're talking about IPO, Creative is the firm that is probably the best candidate, and we can get to this a little bit, is it has the cleanest operating structure. It's not particularly leveraged. In fact, it's arguably under-leveraged. I think it runs at last checked was 2x leverage. And you compare that to the firms that are running at 4, 5, 6, sometimes higher in terms of the net leverage ratios. They have a clean ownership structure with the CEO, Peter Mallouk, retaining majority control. And you have 2 sponsors in General Atlantic and TPG that are in on the same equity, and it's the same share class. So it's all one kind of form of common equity. And Peter Mallouk, to his credit, has begun kind of de-risking his own personal wealth by expanding ownership opportunities to the employees. So the employees have skin in the game. That we talked about that's the issue that happens when you get sold is if that second gen isn't equitized, there's no incentive for them to stick around after their work has made the founder millions of dollars. Why stay if you get no stake in the ultimate outcome?
I think this is the single biggest topic, at least for employees to think about, and owners, obviously, for the next decade, how they retain their talent. To that end, have you seen some funky capital structures in terms of phantom stock and all sorts of things where employees are getting into things that they might not understand that are really benefiting the insider ownership group?
So I haven't got into that yet, but that is a great idea to start some investigations, hopefully. But that stuff is interesting. I mean, we've had things happen where there are one example I can think of is that there are situations where you've seen this kind of almost like college football coaches, where you have someone approaching an earnout or looking for a buyout, and they get fired for cause before they get that threshold, and the seller or the owner or in this case, the football program, they look for a reason to terminate somebody for a cause. You can avoid making that payout. That's one example. You have people that have really interesting provisions, like beyond just non-solicits, non-accept clauses, which may be of questionable legality. But if you're an advisor trying to leave one of these mega sponsor-backed firms and there's a non-accept, I mean, are you going to really be able to kind of beat a firm that's with hundreds of billions in assets and multiple sponsors in court? Probably not. So there's a lot of things in there where, if I was selling, I'd look very carefully at the employment contracts that I have and what kind of clauses are involved with the earnouts. There are also some situations, you talk about kind of the share stuff. And that is a good example. This is something that they talk about openly and promotes kind of competition, drumming up new business. They've rebalanced their equity regularly. So a lot of times advisors that aren't bringing in new business are forced to sell their shares to advisors who are. So that creates kind of an inherently competitive work environment there.
Oh boy, I haven't heard about that. That sounds like a not so pleasant work environment.
Yeah, but again, that's something where they wanted to avoid the situation where you have someone who's got a ton of equity and is just sitting on the beach. It incentivizes you to drum up new business.
Right. Okay, I can understand that. So you reported on Edelman Financial Engines struggling to find a buyer. And not to pick on them specifically, or maybe you can if you want, they're one of the high profile ones, but this is not the last of these stories.
No, absolutely not. I think that, and I said this on our own podcast, This Week in Wealth, there's my shameless plug, talking my own book a little bit. I said that the Edelman failed sale was a big screaming red flag because it blends so many of these kind of issues into one go. Edelman was a firm where their lack of organic growth helped kill their sale process. They've had multiple sponsors there, one of which, Hellman Friedman, has been in that business in some capacity for about a decade. So that's past kind of a traditional 4 to 7 year PE time horizon. And kind of similar to, if you can't sell there's a used car there for a reason. If you can't get out after more than 7 years, there's got to be something causing you to stick in there. So that's kind of a beige flag. Then you also kind of have to factor in that this was a business that had a ton of retirement assets that were relatively low margin, and they had a lot of advisors who were loyal to the founder, Rick Edelman, who now has a diminished presence in that business. And I think, one thing that I'd kind of gathered, we haven't fully fleshed this out yet, is that a lot of the media appearances that Rick did, like his podcast, his radio show, helped drive a lot of organic growth of the business and brought clients and prospects into the door. And when those went away or were diminished or reduced in frequency, some of the organic growth went with that. And so that's kind of what happens when you so into your business model is predicated, setting aside the institutions like working on the referral programs. If a lot of your business comes up from one rainmaker or charismatic founder, well, that kind of key person risk has issues in its own right. So all of that stuff, the PE hold period, the low margin retirement assets, the lack of organic growth, it all kind of blended for this process to fail. And there's no strategic that really made sense that could absorb that kind of business, with the exception of maybe a cap trust or a creative planning. And creative planning, we ultimately saw, bought Sageview.
Where do you see this going? I think the idea that these companies are going to find their mojo, find a Rick 2.0, streamline operations, create efficiencies to the bottom line. I don't see it happening. So what do you think happens ultimately to the equity, to the investors? How does this get resolved?
Yeah, I think that one possibility is you have, similar to what Corient did when its IPO spin out failed, was they did a club deal with a bunch of different types of sponsors. They dealt with pension funds. They used State of Wisconsin. They used private credit private credit restaurant Ares Management. They used Bain. That was an interesting kind of structured investment. So club deals are one option, but those have a lot of kind of complex structures that, PE guys are sharp. It's you're not going to get one over negotiating some sort of pref equity deal with a private equity investor. They're going to get their return one way or another because you're giving them guarantees. Or
wait, hold on. Before you get to the or, I think that I don't know what your or is, but that's what's going to happen. I think the reality is the deep-pocketed investors are going to find a way to just be fine. Now, it might not be the IRR that they were hoping for, but they're going to do something to protect their neck.
Yes, they will make money, whether it's through a liquidation pref or an income pref, or they'll take over. They'll use some sort of pick function on a preferred equity investment to take control of the whole company.
Right.
Like they'll make their money. The sponsors will be fine. The other option is to sell to sovereigns, and that's what CI, Corey, its ultimate parent, chose to do. Was they sold to Mubadala. They sold to Abu Dhabi. We talk about
Fisher did this.
Yep. We haven't talked about this on the pod before, but we've written about Alti Global, that SPAC deal not really working out, and the stock is like down more than 50% from the original SPAC price.
I'm not familiar with that company. So
Alti Global, just a quick primer. It was a SPAC merger originally revealed in late 21, closed in early 23, probably went public January 23. It was a merger between Tiedemann Advisors, big ultra high net worth focused area in New York, a SPAC called Cartesian Growth Corp, and a British money manager called Alvarium Investments. Now, there have been some issues with some legacy Alvarium holdings, such as an international real estate business that was losing money that they've ultimately chosen to shut down. And we broke earlier in the year that they were looking to pursue a form of take private sale. And one of their biggest shareholders is a wealthy Qatari family office. And if you told me that that family office ultimately chose to buy Alti, I wouldn't be shocked by that. It would make sense because all the strongest elements of an REA's business, the perpetual cash flow generation, the fact that it's kind of market exposure, you can safely model the returns out using a little bit of leverage, that makes these very attractive to ultra wealthy family offices and to sovereigns because it's a perpetual cash flow generating asset. And so I can see the sovereigns of the world swooping in as potential rescues for some of these businesses.
And then what? Just holding them?
I can see them holding, in perpetuity. That wouldn't shock me.
Yeah. All right. All the way on the other side of the spectrum, will the $500 million firm survive? Controversial topic, I know. It's expensive to run these businesses. Client demands are not going the opposite direction. Is there room for all of these solo advisors to exist in the future?
I feel like there is in at least some capacity. I mean, the bottom line is that if you have a strong niche, you will find clients. If you can run these businesses fairly lean, your biggest sources of CapEx are staffing and office space. And there are a lot of providers that can minimize those. There are a lot of back-end service providers and consultancies like an XY Planning Network that can help. Now, Charles Schwab itself, going full circle, they started to kind of offer that kind of ongoing business consulting support. So you can get the architecture to run an RIA fairly cheaply. It's just, I feel more, I don't want to say concerned is the right approach. I'm more curious what the strategy is for those $500 to $2 billion firms to survive, where they're bigger than a lifestyle practice, but they're not quite scaled up yet. And a lot of those firms eventually just choose to sell to the mega acquirers. Yeah,
well, I mean, we are seeing that happen. There was a massive hollowing out of the $2 to $10 billion RIA. I think here's where I'm at on the solo, or not even solo, the smaller advisors. I think that glacially, over the next 2 to 3 decades, they will become fewer and fewer because they will get to the point in time where these people either realize I'm big enough that it's like sort of annoying where I'm running a business, or I'm too small where the economics just don't make sense. And at some point, eventually, if we're offering, if the options for the client are I could pay the same fees for this person who I happen to have a relationship with that I really like, or I can go to company XYZ that has a much deeper offering of services, that gradually it will move that way over time. And this is not like a dire warning for smaller advisors. I'm saying like it's going to take like decades, but I think ultimately that's where it ends up.
Yeah. I mean, I'll turn this around. Changes like this happen slowly and then all at once. And you look back and you realize just how much things have changed in 5, 10, 15 years.
That's right. Was that Bernard Baruch, gradually then suddenly? I don't know. Somebody said it. All right. Ian Wenik, any last thoughts that we didn't get to?
Let me think if there's one more kind of conversation topic that once there's some good question. I would say, I'm kind of curious how you guys hire and locate entry-level employees and get them trained up in terms of generating new client business. Because I feel like it's really tough as a 22, 23-year-old or new grad to kind of ingratiate yourself and convince people to trust you with their life savings. And I'll go to Moneta. Moneta has their own kind of in-house university where they train new advisors up. There are firms like the Allers of the world that they let their own marketing engine generate new business for advisors. So I'm curious, how do you guys do it, and what are sustainable strategies for early career advisors to do that?
I think it is extraordinary. I should not hedge with a think. It is extraordinarily difficult for young people to become successful advisors because you need two things. One is harder than the other. One is you need charisma. You need to be born with it. And that is a rare quality. The other is you need time. You need reps. Being an advisor, convincing somebody to give you their life savings is very difficult. And the mistake that young people make, and it's a natural mistake. I'm not saying like, oh, you dumb young people. It's not that at all. I think they tend to over talk, over communicate because they want to demonstrate to the person on the other end of the call of the phone, hey, I am smart. I am proficient. I can do this. And when somebody is talking and dropping a breadcrumb, they're going to be quick to pick it up, quick to over-communicate, not let the client or the prospective client do the talking, explain why they're there, and having the getting to that place where you let the person talk. You hear a breadcrumb, you store it back there, you don't jump in. You hear another one, you store it back there. That's hard. That's not easy to do. And like anything else, it takes reps, it takes at-bats, and guess what? RIAs, reps are gold. Like leads are very valuable. And if there are fewer leads than there were in the future than there were in the past, and I do suspect that's going to be the case, then ownership, decision makers are going to be less likely to give these young people at bats, making it more difficult. So I think what young people need to do is get close to advisors that are working, that are successful, and just hover, be on every call that you can, learn, put in the time, but it's hard. This is not an easy career. And for young people, it's very difficult, more so than ever.
I'm not going to lie, and you'll appreciate this. We just kind of talked about finding a lead and just holding on to it. All I could think of was Adam Sandler and Billy Madison squeezing the kids.
Cherish it.
You've got to cherish it. Cherish it.
Yeah. So we need young people in this industry. And that's that. We need more young people, but it is not easy. So, all right. Not a great place to leave it, but Ian, plug your podcast one more time. How do people get more of you?
So you can find us at citywireusa.com or citywire.com. And then you can go to our RIA website. That's citywire.com/RIA. And then you can listen to the This Week in Wealth podcast on Spotify, Apple Music, and on the Citywire website.
All right. Ian and Wenik, ladies and gentlemen. Thanks, Ian.
Thanks, guys.